What's up everyone? I hope everyone's doing good. This video is going to be over discount and premium. However, before getting into this video, you need to have a good understanding of what buy side and sell side liquidity is. So if you haven't already watched my video on that topic, it'll be better for you to do so you can understand this video a whole lot better. The first thing to understand when marking out premium and discount is you need to find a range. It will be the most recent swing high to swing low, or the most recent swing low to swing high, or the most prominent range in that area. So now I'm going to show you a quick example using something called a Fibonacci retracement tool. So we're going to look for the most recent swing high, which is here, with the most recent swing low, which is down here. And we're going to draw it from the high to the swing low. So we have the premium area of the range and we have the discount area of the range, and then we've got the midpoint, which is the equilibrium. So anything above this 0.5 area is premium, and anything below that 0.5 area is a discount. So now, extending this over to the right hand side, we can now get a clearer visualization of where premium and discount of the range lies. It is important to note that there is not just one range within price action. There are multiple ranges within ranges. For example, we have our first range here. Then we put in a swing low to another swing high where another range has been formed. Then we draw that out, and then we have another premium and another discount area. There are so many ranges that can be found in a set of price action on a chart that can get very confusing. So we'll jump into a few examples that will help clear that up. However, I would first like to explain why we use premiums and discounts in the market. The main reason why we use premium and discount in the market is to show us where our risk to reward can be more favorable in the market. For example, if I was to enter a long position at the equilibrium of the range and I put my stop loss below this low and my take profit above this high, you can see that my risk to reward ratio will be a 1. However, if I move my entry point deeper into the discount area, you can see that my risk to reward ratio, I got tongue twisted, becomes more favorable, and it turns into a 1 to 2. And on the flip side, if I enter a sell position at equilibrium and I put my stop loss above this high and my take profit below this low, you can see that my risk to reward ratio is around about 1. And if I move my entry position deeper into a premium, you can see that my risk to reward becomes more favorable and turns into a 1 to 2 or 2.53. The first example that we're going to look at is the Nasdaq, and on the daily time frame. And the first thing that you're going to want to do is identify the range. So we're going to get our Fibonacci retracement tool, and we're going to mark it out from the range's high, so the first swing high, to the low here. The reason why I've done the low there is because one thing a range does is that they always expand. So when price moves lower, what I'm going to do is I'm going to track the low with our equilibrium range. So we're going to print forward now. Next candle's print. So we'll move that lower. So we're using the equilibrium range to track price moving lower. Got another candle print. So now, after this candle's print, we formed the low. So this low is lower than this low, and this low is also lower than the next candle's low, so that forms a low. Now what we look for are PD arrays in the premium area of this range. So if you look at my previous videos, the two PD arrays that I use are fair value gaps and order blocks. We have a fair value gap from this candle's low to this candle's high. So I'll draw that out in time. So that's our fair value gap from this candle's low to this candle's high, and then we have this displacement candle to the downside. So what I would like to see, I'm going to draw out this order block as well. So we have a daily order block in here as well. So yeah, we have a daily order block there as well. Let me just change that color to purple. So what I want to see is price reach into these areas here before taking price lower to the downside. So if we print again, so price has missed out that fair value gap, so we wouldn't entertain this at all. Just draw it out in time, and would want to move our equilibrium range to track that again. So it just moves equilibrium a bit lower, and then we just have more of a premium area to work with. Then we print again. Price has now reached into that fair value gap, but it's just missed the order block. And then it taps into the order block, literally to the T. And then we move off to the downside and take out the low where the discount was drawn from. Let's print one more. And then yeah, it just continues to move over to the downside. For our second example, we're going to be looking at the DXY, and we're going to be looking on the weekly and the daily time frame. So starting from the weekly, we're going to get our Fibonacci retracement tool, and we're going to look for a draw on liquidity. So we're going to look at this candle, this range here from this swing high point to this swing low. I'm going to label it. So from 0.5 to the high, we have the premium, and from 0.5 to the low, we got the discount area. So, like I said in the previous example, if we're looking for a draw on liquidity, so where price is going to draw towards, if we look in the premium of the range, we have this order block here where price can dig into. It's already tested it and moved lower, but because price is looking like it wants to move higher, we're most likely going to look to dig deeper into the order block and possibly reach for this order block as well. But that's a bit optimistic, so we'll be aiming for this order block first. Moving on to the daily time frame. Now we look for another range to send price to the upside. So we have a swing low down here where we get our tool. So we have the discount area, and then we have the premium. But remember what I said about using the equilibrium range to track price, because price is always expanding to the upside. So got a candle print, so we use it to track the range. Then we get a displacement to the downside, and then we get a displacement to the upside. So with this, in the discount area, we look for discount arrays. So we have a fair value gap from this candle's high to this candle's low. I'll just label that the daily fair value gap. So we have that displacement candle to the upside, and then we have this swing high that's been printed, but because it was so quick, we had that move into the fair value gap. So it's the discount PD array. It's retested it and it's sent price higher to the upside. Then we get another print, which is drawing towards our weekly order block. And then it's moved up to the upside and reached our draw on liquidity on the higher time frame, which was the weekly order block in that premium area of the range on the higher time frame. So notice how it all comes together. So we look for our draw on liquidity on the weekly time frame, which was the weekly order block. Then we went on the lower time frames. We got another range to look for our positions to trade towards our higher time frame draw on liquidity. Coming up to the end of the video, we have our final example on the Euro USD, and we're going to be focused on the daily time frame, and we're going to go down to the 15-minute time frame. So on the daily time frame, the first thing we see is a daily fair value gap from this candle's low to this candle's high. Then we have this displacement candle to the downside that forms the fair value gap. Price has rebalanced it once, it's rebalanced it twice, and it's rebalanced it for the third time, reaching into the midpoint of the fair value gap, a consequent encroachment, and then it displaces aggressively to the downside and forms another fair value gap, which I'll take this from. So we have another fair value gap and a range to work with. So we have this swing high here coupled with this swing low. We'll get our fib tool and then draw that out. And then what we would want to see is price move into the premium of this range, or move into a PD array in the premium of this range. So you could class this PD array as a premium range and premium PD array. And we have this daily order block as well that we could use. So we've got the fair value gap and order block. Now moving on onto the hourly time frame. Now we want price to move into the premium area of the range that we marked out on the daily time frame. So here we have the daily fair value gap, and then we have the daily order block. So we want price to reach above this 0.5 area into these areas, and then we'll start to look for our sell position. So if I print the next day, which is Tuesday, price began to sell off. So we would want to move our equilibrium range, because remember what I mentioned in the first example about tracking the ranges, because they expand. So it's expanded and it's given us more of a premium area to work with. So we still want price to move back into here before we can entertain any other sell positions. So keep printing, and then price respected the daily order block that was printed, and it almost rebalanced the daily fair value gap fully. Then we've got a displacement to the downside, and then moving on to the next day. So price moved higher, respected the daily order block, it displaced lower, and we've got a market structure shift. So we have this low that was printed out here. Price moved higher, it displaced through that low, signaling that price is now ready to move lower to the downside after respecting these PD arrays in the premium area of the range. So moving higher, we can draw out another range from this high to this low. So remember what I said about ranges within ranges. So we can draw another range from this high into this low. You could possibly get a move into there. So this candle here it spiked higher to the upside and respecting this order block. So this order block in this range, let me just draw that out, have an hourly order block. The hour. So we have an hourly order block in the premium area of this mini range here, which was tapped into, and then we got a displacement to the downside targeting Tuesday's lows, which I think it tapped a tiny bit. But if we carry on printing, yeah, it completely digs deeper into it, and then that's the end of that week. So yeah, it's just a range within a range. So we've got on the higher time frame this daily range here where price ran into, then we got a displacement lower, shift in market structure, then we draw another range where price dug into the premium area of that range and then displaced lower to the downside, targeting where we wanted to target. And that's the end of the video. So to summarize everything, we just use premium and discount of ranges just to enter positions that are favorable to us. So for example here, some people could have entered short positions there and put their stop losses above this high. That's a 52 pip stop loss, and we're targeting Tuesday's lows. That's a 1-to-1 risk to reward ratio. Whereas if we had just waited, like I showed you in an example, to reach the premium area of this range, which is around there, we got a 1 to roughly about 1.97. That drops the stop loss to, that's a 37 pip stop loss, and the 74 pip take profit area, which is a roughly 1 to 2, which makes that favorable to us. So that's what we use premium and discount ranges for, and I hope that helps you gain more understanding and knowledge on that. If you enjoyed this video, please just drop a like, subscribe, and share as well. And I hope you have a wonderful day, and man, safe trading.